On that note, Eric, what kind of investor are you? Because like Ricardo said that there are different things that matter. Somebody assigns like disproportionate importance to total addressable market, early traction, product, whatever. Somebody assigns more value towards teams and maybe team dynamic and maybe whys of the problem. Like how do you think about what kind of investor you are and what matters to you when you think about evaluating the opportunities?
Sure. No, a great question. For us, for me, an easy answer for Monashis. The three most important things for us are team, team, and team. So we're early stage. It's team. You know, if we try to outsmart, it happened a few times or several times. You try to outsmart the entrepreneur that really has the vision. If it's the best founders have the vision. Sometimes you say, well, it doesn't make sense. The market is not that large, or this is. And then sometimes you say no, and then they pivot, adjust, and then they build a great company. So the team will adjust, the team will pivot, the team will navigate. I'm talking about early stage, when things are uncertain, when things are unpredictable. I'm not talking about growth stage. Growth stage, you have, you know, the numbers, you have more predictability. So early stage, which is our DNA, it's all about the team, because the team needs the founders that are the best founders. They have a great combination of, you know, and I've heard great points by Gustavo and Ricardo here that are very related to the intellectual side. So the intellect, of course, the problem-solving intellectual side of having the vision, understanding the context, understanding where the business needs to go. I mean, that's a given. You need that, but it's not only that. You know, I was talking before. We define it as magnetism. You know, the magnetism to really sell. You have to attract investors. You need to attract people. You need to attract clients. You need to attract people with your vision early on when you don't have a lot of information. So that magnetism actually doesn't come from only from the intellectual side. It can come sometimes only from the intellectual side. It happens, but it's less likely. But then there's a third component that is critical, which is the gut feeling of what decisions to make that makes you take risk. Actually, the decision to be an entrepreneur is a gut feeling decision. If it's too rational, there's something wrong, because the odds are not in favor of
I love what you're saying, that given that both of those have a consultancy background, there's like,
I tried to make the decision on a rational way and couldn't.
No, you're probably blaming a decision matrix and everything, but it doesn't.
No, but I totally agree with you.
Yeah.
It's a gut decision.
So, and a last point. So, because actually, especially in the early stage, these entrepreneurs, you know, top entrepreneurs, you're constantly having to make trade-offs of things that you don't know. You're trading off. I mean, you're probably one of the best. It may sound a bit of, you know, a lot of people mention it lately, and I think it summarizes very well what we want to see in great founders, which is this strong convictions. This is where I want to go, but at the same time, openness to feedback and openness to learn. This is the hardest thing to find, because sometimes you have one thing or the other. If you're only, I'm very open to feedback all the time, but I don't have strong convictions, you don't get there. If you have only strong convictions, I don't want to hear feedback, you don't get there. So you need both, and they're a little bit contradictory in a way. And the trade-offs that you need to make as an entrepreneur, you know, how fast should I go? You know, faster is better, because then I get more, the advantage, but faster burns more cash. Or actually, should I be capital efficient, or I need to burn in the beginning. You're not going to be profitable from day one. So you need to find the balance and the trade-off of these things. And great entrepreneurs have the conviction, learn, are open to feedback. That's why the importance of attracting the right team and the right advisors and the right investors, so you get the right feedback.
We talk about the right partners, but let's stay on this for 1 second. So the magnetism, the intellectual capabilities, the gut, the drive, those are all very intangible sort of like skills. Let's call them skills. I don't know if that's the correct way to call them. How do you test for all that during the conversations with the founders? What kind of questions you ask? What kind of dynamic you're paying attention to? Like, how do you know if that is present?
That's the billion-dollar question. I mean, it's hard. You don't get it.
How did you
right
know
away.
that it was present in this guy, for example?
It wasn't.
No, it was. I mean, I think everything I described here, I think I can apply to Ricardo, and it made us. We didn't have. The only thing, of course, I mean, there were some issues with regulation that we analyzed, of course, in the business. But in terms of the team and Ricardo and the founders, we were very, from the very beginning, have a lot of certainty. Of course, this is you define it very well. It's intangible, but you observe things. You observe the. I'll give you a negative example. I don't know why it popped up in my head, but I mean. And I'm sorry because I'm being unfair with this, but I mean, if there's a pitch, and if I ask something to the entrepreneur, but actually, and I ask a question that is not related to that slide, it's related to a different topic. I'm being unfair here, but if the entrepreneur says, I'm going to get to that point, just wait a little bit and I'll get to that point. Just don't interrupt me because I have everything structured. I think that shows a lack of adaptability. You need to be adaptable. It's just a simple, maybe not a really good
example. Yeah, but that is
example.
the thing. That is like these little things that you're
Little
picking
there are
and
little
paying
cues
attention
you
to.
get of who that person is. If he has, and of course it's we're not right all the time. I mean, we try to make good calls. We have the benefit in early stage. You see that you build a portfolio in order to deal with that risk, and so you can. You don't have to be right all the time. But we try to look for the cues for the intangible in the conversation. We will get to that point, but it has a lot to do with the questions that the entrepreneurs ask too.
I want to get to you for 1 second because I have this benefit of interviewing him on the podcast. And the thing that you said earlier, that there's no magic to the fundraising, I actually would argue that the magic to your fundraising, for example, was the process itself, the way you set up the process. So if you could maybe elaborate a little bit in terms of how you treated fundraising as a process, how you leveraged your consulting lens in crafting this deck, and I'll have a couple follow-on questions on that.
Yeah. No, so as I told you in the interview, in the beginning of the company, in the very first 2 or 3 months, I spent a lot of time fully dedicated to this. And I actually, because we discussed this a lot, I kept thinking about what I told you in the interview, and I think I gave you an incomplete view of how and why I did that.
It's a great opportunity to fix that.
Because I think, when you say, you stop, you delegated to your co-founder for him to run the company for 3 months in the beginning, so just look at your slides. It gives the impression that I'm working a lot on how we're gonna look instead of who we are, and I think that it's always better to spend energy being good instead of trying to look good. And the reality of that process to me was that in the beginning of the company, I needed clarity, around the strategy. I think we had all of these vague ideas on what we wanted to create, and the direction was more or less set. But the most utility for me from that process of just sitting down and hammering my head against the wall for weeks and weeks was to create clarity for myself, on who we wanted to be and what was going to be our strategy. And they usually say that writing, for example, is very good, not because of what you write, but what the writing changes in your mind, right? And that process of creating a structured deck and trying to be very clear. I think that you asked Eric the most overlooked quality. My very sharp answer to that is clarity. I think that clarity, and talking to many folks around many companies and looking to my own company, I think that clarity is probably the most scarce, super valuable quality Someone can have, the capacity to create clarity of ideas in discussion and environment. And yeah, so what I tried to do was just to, really go deep and make it crystal clear on what we were not and what we're going to be. And when that translated to slides, it was very easy, because what I was doing during the process of fundraising, when I was trying to communicate like what we're trying to build, I didn't have to spend time memorizing the slides. I just put my mind out because I had sort of like solidified very clearly on how I think about the business. So, and yeah, that made it much easier.
So clarity means eliminating a lot of stuff, right?
Yeah.
So what did you intentionally leave out of that deck? And how did that sharpen the core message? And I'm not saying like you need to call out the specific things, but conceptually, how did you think about what contributed to the clarity and what should have been removed to preserve the clarity?
No, I think a bunch of things, like Eric mentioned, for example, like, the why we're doing this, like the deep reasons on why we're doing this. I think that, those things, they will come out in later conversations, they will come out in another moment. Something that helped us in thinking on what to leave there and what to take it out was this very clear idea that, the deck has a mission, and that is to get investors excited for the first meeting. And that's it. And they use that to like explain the high level and the overall of how your business work, but that's it. Don't try to do more. I think that when I go through like other founders' decks, what I see is just too much stuff. They're trying to tell everything there. So, and I'm going to be a bit boring here, but there is like a how-to on how to do this. It's what are the pain points, how are you going to solve them, who's the team, the market is here, etc. Like that won't give you, that won't get you through the finish line. But in my case, I tried to make it very short, very sharp, as clear as possible, and leave the details, for other things. Like Ricardo mentioned, like the regulatory stuff. Our business is like ultra regulated. We have 9 different regulatory licenses with, 3 different regulators. Brazilians don't understand that. Like, no way I'm going to go to a US fund. I'm going to be honest, and I hope I don't offend anyone. And I can say this because there are many investors in my cap table, so you're not going to know who I'm talking about. But like, there are investors who've been for me for years, and they don't still understand what we do. So I think it's poor to have the intention to explain that in a single deck. So yeah.
I love it. Eric, do you have anything to add to that?
No, there's so much you can do on that, but I totally agree with Gustavo on the clarity part. But clarity is a reflection of that intellectual process and communication process of structuring a problem, of communicating a problem, very objective way. So the clarity, I think it's a great proxy to the ability to problem solve, because you're problem solving the communication of that deck. And so I totally agree with that. But when there are very complex businesses that are local, like yours, that's then you have to do what you can, but you don't need to over stress it. And investors will see the numbers and will get the other cues and invest. And they don't necessarily, some of them, really need to know in detail every detail of the business.
I think I would say we as consultants probably learned that communicating concisely and clearly it's much harder than actually being long and overly extensive in communication. And I think that's the exercise. First, you need to make sure you have the self-reflection of knowing what your strategy is and what's important to it, and make sure that's there. 2, you need to make sure you know what are your high qualities, what are you doing super well and differently than everybody, and what's critical to your business, and make sure those are in there. And then make sure you remove everything else that can appear in a different place in the conversation. For example, we are a regulated business and we don't talk about regulation in any of our first pitches, because that's complex, that's technical, that's going to come up eventually. You don't need to open the door with that. And up to now, when Flash is a big business, we can still communicate our entire business and business vision and where we're going in 10 slides. So that's still the target. Be concise, know what your great strengths, they need to be in there. They open the door and they generate interest and they generate interest and go deep, and remove everything for later conversations. You're going to have to eventually build the pages on everything else because they're going to ask, you're going to explain, they're going to understand half of it, and then you're going to have to put it on paper so that they actually understand the 9 different types of regulation and et cetera. But you'll do it in time, not initially.
And just one more thing, because I really reflected on our conversation there. And
I'm so proud of that, actually.
I think that another like wrong message that that may come around if not properly explained is like when you say, oh, you spent like 2 or 3 months just doing the pitch deck, someone may take away from that oh, he spends a lot of time in the process. But actually, when I look to the combined time I spent thinking about fundraising during like the last years of the company was much less than other founders. And the reason for that was, again, that because for one time, I spent a lot of time creating a lot of clarity, I didn't have to touch my deck again. So throughout like the last 3.5 years, I changed very, very little. Every time I go into a conversation, I shouldn't tell this to people, but the discourse is more or less the same. I just play, hit the play button and that's it. And because I spend time like working on a formula that works, I don't have to worry or stress every time I go into a conversation. I just hit the play button and it does its magic.
So let's talk about capital, choosing the right partners, okay? And we'll stay on the topic of clarity for a little bit. And I want to start with Eric, because normally the way founders run fundraising, they get in a room with an investor, and then they pitch themselves really hard. And they never ask questions. And I think it probably is a sort of a red flag for an investor, because like you said to me before this, that it's a two-way street. This is the relationship. It's like, it's more durable than an average marriage in Brazil. So what do you think are the critical questions that you think founders should be asking investors during pitch meetings, but often don't ask?
Good. I think it's one of the most important aspects of fundraising. We always, since the very beginning, we always leave time at the end of the meeting, of any pitch from an entrepreneur. We leave 10 minutes. We try to leave. It's always hard. But we always at the end say, okay, now what are your questions to us? So we always leave and intentionally ask, so what do you have to ask us? Because I really think you learn a lot, sometimes even more, from the questions than from the answers. Because answers like, okay, you rehearse, you solve a problem, but questions really shows also what your genuine interest is in the relationship with the investors. This is a long-term relationship. So we want to partner with entrepreneurs that are also choosing us. We don't want just, we need a check from whoever wants to be with us. No, we want also for this relationship be a two-way relationship. And you would be surprised by how many times, and the vast majority of times, we leave 10 minutes at the end. And even today, with all the entrepreneurs actually talk to each other, and I've said many times the importance of questions. Even today, at the end, there's no questions. Or there's a question, how is the process? When are you going to make the decision? Or something like that. No, I'm being honest. And of course, you don't want like all these most insightful questions in one conversation you're putting on the spot, but just a couple, again, going back to the authenticity of, I'm sure founders have questions. And to ask questions, and maybe some difficult questions, also shows boldness in a situation like that, which is also what you want. So there's a lot that's communicated from the questions. And of course, we have ideally several conversations, follow-up conversations, when the first conversation goes well, that we can explore those questions. So probably one of the best questions I got, just as a joke, in one of these conversations was, so I said, so what, do you have any questions for me? And the entrepreneur thought, and he was a little bit on the spot, and said, what would be the best question for me to ask you. So it's a good one to get out of the problem. But anyways, I think the best questions are related to trying to understand who we are, how we work, what do we believe is a good partnership, how do we help the company? I know this is almost obvious, but I mean these are great questions. But just get it going and shows the interest from the entrepreneur in learning who we are. So the best founders will have 2, 3, 4 term sheets and will make a decision. And this decision has to be made on this two-way relationship.
So on the good and bad partnership, Ricardo, again, putting you in a hot seat because you have this diverse set of investors, and I know that you reflect a lot in terms of partnerships and what good partnership is. In your perspective, like what have you learned about partnership? What are the signs of a good versus a bad investor partner in your mental framework?
I'll give you the long answer. First, I think, and it's hard to identify initially that, but you need to start to identify which type of investor you're talking to out of those, several exist, but you start to categorize them in kind of these buckets of types of investors. And I think what's a good and bad depends on who they are. They won't change. What do you expect from them and what they can actually add in terms of, or remove in terms of value for you. So expectation is clear, and you should have the expectation for the type of investor they are. In the early stage, you're probably talking to angels and early stage funds, right? I've had fantastic angels that were coaches, mentors, advisors in certain topics. And I've had angels that were a check. Maybe credibility, maybe a connection to somebody or someone. And I think making sure who do you want as angels and why, and what proportion of the round they're going to take, and what are they going to add value in terms of, in addition to a check to you, is very important. And if that's clear enough and transparently communicated, even better, because they can't say afterwards that they didn't know you expected that from that, etc. I think I've had luck with most of mine, and I've had angels that helped me learn how to fundraise. I've had angels that were thought partners in, let's say, complicated situations to try and figure out what to do. And although I love my fund investors, it's a conflicted relationship by nature. So angels are a bit more easier to have certain management of certain conflict situations in the future. For funds, in the early stage, it's harder, but you need to try and learn what are the key skills, as Eric was saying, and what makes Fund A different from Fund B and from Fund C, and what you can expect from them. Are they operators? Are they founder-friendly? Are they going to help you fundraise in the future? Are they going to be there on the tough times? Are they, I was going to use a bad word. Are they hard to deal in specific topics, etc.? How are they on board meetings, and how do they add value on those discussions? Those are all things that you need to learn about those early stage investors, and they are all different. And really talk to people who have both good and bad experiences with them, and that will allow you to learn what they're good and what they're bad on your day-to-day outside of the sales pitch moment. And that's why I say prepare for the fundraising process before you're running it, because it's hard to have those conversations as you're running the process. And finally, with later stage conversations, those become even more diverse. You can have investors which are really financial. They are not operators. They are not going to help you with decisions of how to build your team, business operation metrics, maybe very high-level strategic discussions, but not roadmap discussions or choices, etc. Versus folks that are more hybrid, going into more details, are going to add value on your board, on your tough dilemmas, etc. How they actually operate on the board, who's actually going to be the partner in your board, and how they are in other board meetings. Are they just formally there, or do they truly add value, and are your thought partners for doing board meetings and in between board meetings? Those are all things that you should learn about the investors, and also learn their style, their type, which also is going to change what they are able to add value in addition to a brand and a check, which is important as well. But those are things that you should, let's say, research. Maybe not at the beginning, but during your conversations as you're maybe evolving with a few, what are the trade-offs and what are you choosing? And what should you be choosing? For example, in our last round, we had 3 participants. We wanted somebody more closer, more value add, more that had business operating, very high level, big, strategic, large companies, but operating them and being as a thought partner on those, in addition to financial, because on our previous round, we had a very financial investor, which was a very different. So we were conscious about doing those, and we actually chose a lower valuation to be able to combine different types of investors and have that in our cap table. So combining brand, financial, and business operator all in a single round. And we chose who we wanted on our board out of the 3 because we wanted that specific skill set on the board. So those were conscious decisions that we made throughout the process, but while evaluating the right combo of investors.
What about you, Gustavo? What's your take on the good partners versus red flag type of partner on the cap table?
Yeah, I mean, he said a lot about it, but just to add on top and to maybe put emphasis on a few things. And talking specifically about funds here, institutions, the partner, the person really, really matters. I feel like people sometimes underemphasize that, you know. So I'll put a lot of attention to that. And also it's very easy to look to one person or one institution in isolation and think, how do you think about that, right? But I think the way I try to approach it is think about how that person or that institution is going to behave, or what's the value of that thing in the mixture of the rest of the investors, the rest of the board, how that relates to me specifically, you know, because I don't know, if you have a co-founder, probably one of you is probably leading the relationship with the board and the investors, and you know, the optimal choice of partners to me is a different one than my co-founder. So we would have a probably very different board if he was optimizing for himself. So just trying to be very specific and also very alert of the context is really important. So yeah.
Unlike a little bit on the process side, I'm sure Eric's in a lot of the situations, especially during the hype of the market, like there was COVID, when the timelines of the decision making suggested by founders were extremely, extremely short. Like deals were closing in like 24 hours. Like there's no way anyone can do any form of meaningful due diligence. So how do you think about this sense of urgency that a lot of investors and advisors advising startups to generate to prompt deal to happen faster? Like what's your take on the sense of urgency?
Of course, on our side, this generating FOMO and generating a lot of competition and putting a lot of short deadlines, they can generate economic value for the founder. So it's fair. It's part of the game. I don't think it's very positive. I think it's hard to generalize and to say, oh, it will always go wrong if it's that way. No, there are many examples that it can work. It's of course by far not our preferred situation. We want to have time to get to know the team, and the team have time to get to know us and make the decision for the right reasons, and not just because, hey, I need to maximize the value here. Sometimes, of course, now there's a lot of information in the market, so many founders already get to a fundraising effort with a lot of information from the types of investors you want to attract by speaking to getting reference checks, talking to other founders that have investments from those funds. So I'm not saying that, oh, every time you're getting with zero information. No, it's not the case. So we understand. Today it's happening a bit more in AI, localized. In between 2019, 21, it happened everywhere. I don't think it's very healthy. I think it's better to have time. and I think it's kind of back to basics now, and in how it should be. I think in the end, it's a decision. It's a 10-year decision. It's more than 10 years. I mean, if I'm a founder, I don't think it's something you want to really make in 1 day or 3 days. Even though, of course, I think it's important for us also to put into perspective that there are 2 reasons for a round to be expensive or to being closed very fast. There are 2 reasons, and it's our job, and it's not easy to separate, which reason is the reason here, because when the deal is fast or it's expensive, because everything is fast and everything is expensive, that's a very bad reason to participate. When it's fast and expensive because that team is unbelievably competent and doing an incredible job, and even in a Series A, when you have metrics of product market fit, it's showing an amazing number there, and so it's expensive and it has to be closed in 3 days. That reason, generating competition in a situation that is fair and is part of the game, and we will fight to get in. But it's hard sometimes to really separate the 2 reasons.
What's your take on the sense of urgency?
It's one of the tools we as founders have to manage a process, and I think one of the learnings is you have to manage the process and not be managed. My point to think about it as a process, prepare before and run it. If you're being run, you're probably leaving something on the table. But I think you get what you prioritize and what you end up exploring the process. And I was going to point on that, adding to our previous point to Eric's, which is if you only prioritize speed and valuation, that's what you get. But you get a bunch of other downsides. You get a fund that probably pays high, but is a pain later on governance and on not caring about anything else than the numbers when something is going wrong, and not being supportive when you need it, or not being able to add value and help you on strategic discussions or anything else. If you ask me, would I extend 1 or 2 weeks to make sure I'm really getting to know them, doing the diligence on both sides and exploring those, and getting a better deal long-term for the company, not necessarily the better deal I can get in 2 days or the better price, I would make that exchange every single time nowadays, etc. So I think, again, back to the types of investors and making sure what are the bad things and learning the things that you need to negotiate in the deal and watch out for. Structure, warrants, rights, vetoes, types of behaviors in bad times, how they're going to behave, etc. Who the partner is and how much he adds value on a day-to-day basis or destroys value in certain cases, etc. Those are all things you should get to know, and doing that in 2 days, you're not going to do. You're going to maximize price and speed versus anything else. Maybe that's the right thing sometimes, but most often I don't think it is.